Hello, welcome YouTube investors. Are you a European investor feeling limited by government regulations when it comes to investing in the US ETFs? As an individual investor, your options might seem restricted, but don't worry because there is a solution. Let's explore how you still can access the lucrative US market and supercharge your investment portfolio. At the end of this video, I will review a straightforward and legal workaround that enables European investors to continue investing in the US markets. I will demonstrate this shortly, but first let's understand why these regulations exist, right? So let me explain. So since 2018, individual investors in Europe have been restricted from investing in US ETFs. Professional investors have fewer rules to follow compared to regular investors, as they are assumed to have more experience and expertise to understand and manage the risk associated with their investment. So, as a result, individual investors have limited access to certain investment products, such as US ETFs, that are considered more complex. And as a European, you can get around this restriction by becoming a client with a professional asset manager, or alternatively, US brokers might make exceptions for clients who have more than 500,000 euros in their portfolio. So why do you have to deal with UCITS regulations, and what is it anyways? So UCITS stands for Undertakings for Collective Investments in Transferable Securities. In other words, UCITS is like a set of rules made by Europe for investment funds. It makes sure that these funds are safe and work the same way in different European countries. But don't fear, because there is another option to get around this regulation, what I will share with you in a moment. But first, let's see what the cons and the pros are if you want to invest in the US. So, how do ETF markets compare between US and UCITS in Europe? So, as of August 2023, the global ETF market was divided into three major segments. Asia Pacific and Latin America collectively held over 11% of the market share, while UCITS in Europe accounted for 16%. And US ETFs dominated with a total amount of 73%. So this big difference in market share shows why it's crucial to understand the important factors when investing in different ETFs across these segments. That's why I will be sharing the 5 most important factors you should pay attention to. The first factor is liquidity. US ETFs generally have higher liquidity, which is often attributed to the size of the US market and the presence of numerous large established ETFs. The most US ETFs have bigger size in total net assets. In ETFs, good liquidity means you can buy or sell shares easily even when the market is moving fast. The second factor is trading volumes. US ETFs have larger average daily trading volumes, primarily due to the substantial size and depth of the US financial markets, and this can lead to tighter bid-ask spreads. So why is this important? This is important because US ETFs are traded more frequently each day, mostly because the US financial markets are big and busy. This means the difference between buying and selling prices are smaller, making trading easier and cheaper for investors. So then we come into factor number 3, lower expense ratio. Expense ratios are usually lower in the US markets because of competitions and economies of scale. This means that the fees for US ETFs are often cheaper. And this happens because many ETFs in the US are competing, so they keep their fees low to get more investors. And it's important because lower fees means you get more returns. Fees and returns are directly connected, so lower fees usually mean higher returns for you. And at first glance, the difference in cost may not seem significant, but when you consider compound interest over the years, this really can add up. So you can see the importance of cost while investing in ETFs over the long term in this video. Then we dive into factor number 4. Factor number 4 is that you have broader diversification and include more companies in your portfolio. The exact number of companies depends on the ETF you select. So, for instance, if you opt for a global equity fund in Europe, you will have an exposure to more than 3,665 companies. However, if you choose a global equity fund in the US, you will be invested in over 9,848 companies. This is crucial because diversification helps spread risk across different companies and sectors. And by investing in a larger number of companies, you reduce the impact of any single company's performance on your overall investment. And this can help mitigate risk and potentially improve long-term returns. So then we dive into factor number 5. It's all about taxes. And this one is crucial. It's essential to research this for your own country because for countries without an income tax agreement with the US, you pay an additional 15% dividend taxes. And additionally, you may also be subject to the US estate taxes. If you are not a US resident, estate taxes in the US kick in once your US holdings reach $60,000. And these taxes are charged at rates between 26 and 40% of assets above that threshold if there's no US estate tax treaty in place. Only 16 countries have such treaties with the US, and in Europe that are as follows: Austria, Belgium, Denmark, Finland, France, Germany, Greece, Ireland, Italy, the Netherlands, Norway, and Switzerland. And lastly, the United Kingdom. So from what I have heard, the UK still maintains tax agreements with the United States despite not being part of the Eurozone. So if your country doesn't have a tax agreement, you end up paying much more in taxes, which eats into the benefits you would otherwise enjoy. Now that you are aware of the pros and the cons, let's dive into the straightforward workaround for European investors who seek to reap the benefits of US ETFs. So normally the sign-up process is really straightforward, right? And you only encounter restrictions after signing up with a broker and attempting to access the US ETFs as an European investor, right? So after extensive research, I have finally found a broker with no limitations. And it's called Tasty Trade. And it offers low cost without any restrictions for buying US ETFs. However, the only downside I have found is that you cannot purchase any UCITS ETFs on their platform, so there is still a slight limitation. But still, you are able to buy the US ETFs, and I have used this platform for over a year now, and I think it's pretty good for buying these simple ETFs from the US. But I will share my experience in a later video. So I have included the broker sign-up link below in the video in the description. And the second thing I want to mention is that when you buy US ETFs, they are priced in dollars. So Tasty Trade does not offer any currency conversion services. So you will need to convert your euros into dollars before you can deposit your money into your Tasty Trade account. But converting the money and transferring it into your account is not a big deal. So with these kinds of strategies and choosing the right ETFs, you can influence and improve your long-term returns. And I know this may sound strange and you might think, but Maurice, will that really make that much of a difference? But perhaps you are not familiar with the power of the compounding effect. This holds incredible power, and it's better to harness it to work for you rather than against you, right? So you can watch the rule of 72 and the power of compounding effect in these videos above. And if you found this video helpful, please subscribe to my channel and let me know if you have any questions about this topic, and I will be happy to help you. See you in the next video, and don't forget to subscribe.